It hit 100 in April last year and reversed. It is a level where selling pressure comes in because the strong dollar starts hurting U.S. exports and U.S. corporate earnings, and the economy starts showing strain. And every time the dollar reversed from 100, gold and silver rallied hard. That pattern has repeated multiple times. I'm not saying it will repeat this time, but I am watching 100 on the DXY like a hawk, because if it reverses from here, the precious metals move that follows could be explosive. And here's the flip side that I need to be honest about. If the dollar does not reverse at 100, if it pushes through to 102 or 103, then we are in uncharted territory for this cycle. A dollar above 100 and pushing higher means the war premium and the safe haven demand are stronger than the historical resistance. In that scenario, gold could test 4,800 or even 4,500, and silver could revisit the low 70s. I'm not predicting that, but I am preparing for it, because in a market this volatile, the only sin is being unprepared. Both scenarios are on the table. Dollar reverses at 100 and metals rip, or dollar breaks 100 and metals go lower. The data will tell us which one, and I will be here to break it down either way. Now, let me show you something that most precious metals investors are not watching, but I think is the most important development of the week. Bond yields in Europe are exploding. Pull up the UK 10-year gilt yield. It has risen nearly 50 basis points in the last 2 weeks. 50 basis points. That is a massive move in government bonds. The UK economy is flatlining. Growth is near zero. The government was banking on lower interest rates to fund their spending plans, and instead, yields are surging higher. That means the cost of borrowing for the UK government is going up at the worst possible time. Their budget projections are based on lower yields. Higher yields blow a hole in the budget, and a budget crisis in one of the world's largest economies creates ripple effects across global markets. Germany is even worse. Pull up the German 10-year bond yield. It just hit new high territory at 2.95. Germany's economy is in dire straits. Manufacturing is contracting. The energy crisis from the war is hitting them hardest in Europe. And yet their bond yields are rising when an economy is weakening, and bond yields are rising at the same time. That is stagflation. That is the worst combination in economics. It means inflation is winning while the economy is losing. And central banks cannot fix both at the same time. If they raise rates to fight inflation, the economy breaks faster. If they cut rates to save the economy, inflation gets worse. And here is why this matters for gold and silver. Stagflation is the single most bullish macro environment for precious metals. Every period of stagflation in the last 100 years has produced massive rallies in gold. The 1970s, 2008, and now 2026. When bond yields are rising because of inflation fears and economies are stagnating because of war and energy shocks. The only asset that protects purchasing power is gold, and silver follows gold with leverage. The bond yield explosion is telling you that the inflation from this war is real. It is not transitory. It is not going away when the war ends. That's right. We're talking about gold and silver. For centuries, these two have been the ultimate symbols of wealth and stability. But in today's fast-paced economy, are they still the safe haven we've always believed them to be? Let's break it down. First up, let's look at the big picture. The global economic landscape has been, to put it mildly, a roller coaster. We've seen inflation rates hitting levels we haven't witnessed in decades. When the cost of everything from your morning coffee to your monthly rent goes up, the value of your cash goes down. This is where gold traditionally shines. Investors flock to it as a store of value, a way to protect their purchasing power when fiat currencies are weakening. Think about it this way. A central bank can print more money, but they can't print more gold. This inherent scarcity is what gives it its long-term appeal. So when we see major central banks like the US Federal Reserve talking about interest rates, the gold market listens very, very closely. Let's unpack that relationship. When central banks raise interest rates to fight inflation, it makes holding non-yielding assets like gold less attractive. Why? Because you could be earning interest from government bonds or even just a high-yield savings account. And these are considered safer returns. So higher interest rates typically put downward pressure on gold prices. We saw this play out quite a bit over the past year or so. As rates climbed, gold's upward momentum was capped. However, the story doesn't end there. Now, the conversation is shifting. The market is starting to anticipate when these central banks will begin cutting rates. The moment that happens, or even when we get strong signals that it's coming, the dynamic flips. Lower interest rates decrease the opportunity cost of holding gold, making it a much more attractive asset again. This is the key factor that many analysts are watching right now. The timing of that first rate cut is the million-dollar question for gold investors. But it's not just about interest rates. Geopolitical tensions are another massive driver for gold prices. Whenever there's instability in the world, whether it's a conflict, a trade dispute, or political uncertainty, investors get nervous. They pull their money out of riskier assets like stocks and look for safety. And what's the oldest safe haven asset in the book? Gold. It's seen as a port in the storm, a reliable asset when everything else feels uncertain. We've seen this time and time again. A flare-up in global tensions almost always corresponds with a spike in the price of gold. So we have this fascinating push and pull. On one hand, the prospect of prolonged high interest rates is a headwind for gold. On the other hand, persistent inflation and geopolitical risk are strong tailwinds. It's a tug-of-war, and the price of gold is the rope in the middle. Now, let's not forget about silver, gold's more volatile sibling. Silver is a fascinating metal because it has a dual personality. Like gold, it's a monetary metal and a safe haven asset. People buy silver coins and bars for the exact same wealth preservation reasons they buy gold. When gold rallies, silver often follows, and sometimes it can even outperform gold, although it's usually with a bit of a delay. But here's where silver gets really interesting. Unlike gold, which is primarily used for jewelry and investment, over half of all silver demand comes from industrial applications. That's huge. Silver is a critical component in so many things we use every day. It's in your smartphone, your laptop, and the solar panels on your roof. Its incredible conductivity makes it essential for electronics. This industrial demand ties silver's fate directly to the health of the global economy. If manufacturing is booming and industries are growing, the demand for silver goes up, which can push prices higher. This is especially true with the green energy transition. The push for solar energy is a massive catalyst for silver. Solar panels require a significant amount of silver, and as the world continues to build out its solar capacity, that demand is only expected to grow. The same goes for electric vehicles, which also use more silver than their gasoline-powered counterparts. So, for silver, you have to watch two things. You need to look at the monetary factors we discussed with gold, inflation, interest rates, and investor sentiment, but you also need to look at industrial output, manufacturing data, and the pace of the green energy rollout. This dual nature is what makes silver so volatile. If the economy is slowing down, industrial demand can fall, which can hurt the price, even if investors are buying it as a safe haven. It's a complex dance. Let's talk about a key metric to watch, the gold to silver ratio. This ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has fluctuated, but looking at its average can give us clues about which metal might be undervalued relative to the other. When the ratio is high, say above 80 or 90, it suggests that silver is relatively cheap compared to gold. Many traders see a high ratio as a signal that silver might be poised to outperform gold in the near future, expecting the ratio to revert back to its historical mean. Conversely, a low ratio suggests gold might be the better buy. Keeping an eye on this simple number can be a powerful tool for timing your investments in precious metals. So, what's the prediction for the future? Well, nobody has a crystal ball, but we can look at the trends. For gold, the consensus seems to be cautiously optimistic. The main driver will be the pivot by central banks toward lower interest rates. Once that happens, many analysts expect gold to break out and potentially reach new all-time highs. The continued demand from central banks themselves, who have been buying gold at a record pace to diversify their reserves, provides a strong floor for the price. For silver, the outlook is perhaps even more exciting, but also riskier. If we see a soft landing for the economy, meaning inflation comes down without causing a major recession, it could be the perfect storm for silver. In that scenario, you'd have falling interest rates boosting its monetary appeal, combined with a stable or growing economy supporting its industrial demand. The green energy narrative is a powerful long-term tailwind that isn't going away. Many believe that silver is significantly undervalued right now, especially when you look at the supply-demand fundamentals. We've been in a structural deficit for a few years, meaning we're using more silver than we're mining. Over time, that has to resolve with higher prices. Of course, we have to talk about the risks. The biggest risk for both metals is a higher for longer interest rate scenario. If inflation proves to be stickier than expected, and central banks are forced to keep rates high or even raise them further, it would be a major headwind for precious metals. A deep global recession would also be a mixed bag. It might increase safe haven demand, but it would crush silver's industrial demand, potentially hurting its price. So, what can you do with all this information? It's crucial to do your own research and understand your own risk tolerance. Precious metals can be a great way to diversify a portfolio and protect against inflation and uncertainty. But they're also volatile. Don't go all in based on one video. Consider your long-term goals. Are you looking for short-term gains, or are you trying to preserve wealth over the next decade? The key takeaways are this. Watch the central banks, especially the Fed. Their policy on interest rates is probably the single most important factor right now. Keep an eye on geopolitical hotspots, as any escalation will likely send investors running to gold. And for silver, pay attention to both those monetary factors and the health of the global manufacturing sector. particularly the green energy space. The gold to silver ratio can be your guide to see which metal might offer a better value proposition at any given time. The world of gold and silver is always moving, always reacting to the complex tapestry of global economics and politics. It's a fascinating space, and staying informed is your best tool. We'll definitely be keeping a close eye on these markets, and we'll bring you updates as the story unfolds. Thanks so much for watching today. I hope this breakdown was helpful for you. If you got some value out of this video, please give it a thumbs up. It really helps the channel. And if you want to stay on top of the latest market analysis, make sure you hit that subscribe button and turn on notifications. I'd love to hear your thoughts in the comments below. What's your prediction for gold and silver? Let me know. Until next time, take care and invest wisely. A lot of you have been asking about it, and for good reason. We're seeing some really unusual signals that suggest something big might be on the horizon. Is silver setting up for a massive rally? Let's break it down. First, let's talk about something called open interest in the futures market. Think of open interest as the total number of outstanding contracts that haven't been settled yet. It's a key indicator of market participation and sentiment. Right now, the open interest for silver on the COMEX is at historically low levels. This is really significant. Typically, low open interest suggests a lack of interest or participation. But in this case, it might be telling a different story. It could mean that the so-called hot money, the speculative traders who jump in and out of the market, has largely exited. What's left are the more committed players, the ones who are in it for the long haul. This creates a very tightly wound spring. With fewer speculative sellers to cap the price, any significant buying pressure could have an explosive effect. It's like a room with fewer exits. When people start rushing in, the pressure builds up much faster. Now, let's connect this to what's happening in the physical market, because this is where things get really fascinating. While the paper market, the futures contracts, is showing low participation, the demand for actual physical silver is incredibly strong. We're seeing a huge number of contracts standing for delivery. This means that instead of just rolling over their paper contracts or closing them out for a cash profit, a growing number of investors are demanding the actual metal. They want the bars, the coins, the real thing. This is a massive vote of no confidence in the paper price. When market participants would rather deal with the costs and logistics of taking delivery of thousands of ounces of metal than they'll hold a paper claim, it tells you they believe the physical asset is far more valuable than its paper counterpart suggests. This leads us to the growing disconnect between the paper price and the physical price. If you try to buy silver coins or bars from a dealer, you will notice you have to pay a significant premium over the spot price you see on your screen. This premium is the market's way of telling you there's a shortage of available physical metal. The paper market can create as many contracts as it wants, but there's a finite amount of physical silver available for immediate delivery. The warehouses have a limited supply. So, while the paper price might be suppressed by a low number of traders, the real-world demand is pushing the price of the actual metal higher and higher. This gap between the paper and physical worlds can't last forever. Eventually, something has to give. The paper price will have to catch up to the reality of physical supply and demand. To understand where we might be heading, it's helpful to look at history. Silver has a reputation for long periods of quiet consolidation followed by explosive parabolic rallies. Think back to the late 1970s or the run-up to 2011. In both cases, silver went on an incredible tear, far outperforming gold and other assets. What were the conditions back then? You had monetary uncertainty, inflation concerns, and a growing realization that the paper price didn't reflect the true value of the physical metal. Sound familiar? The patterns we are seeing today, low speculative interest in the paper market combined with a mad dash for physical metal, are eerily similar to the setups that preceded those historic rallies. So, what does all this mean? It suggests that the silver market is coiling for a potentially massive move. The low open interest has cleared out the speculative sellers. The high demand for physical delivery is draining the available supply from warehouses. And the widening gap between paper and physical prices shows a fundamental tension that must be resolved. When you combine these factors, you have the recipe for a classic silver squeeze. But this one might be driven not by a coordinated online campaign, but by fundamental market forces that have been building for years. The lack of speculative froth means this isn't a bubble waiting to pop. It's a fundamental repricing based on real-world supply and demand. Now, let's look at the bigger picture. Why is this happening now? We're in an environment of persistent inflation, where the purchasing power of our currencies is being eroded every single day. Central banks around the world continue to print money, and governments are running massive deficits. In this kind of environment, hard assets like gold and silver have historically served as a safe haven, a store of value. But silver has a dual nature. It's not just a monetary metal, it's also a critical industrial metal. It's essential for solar panels, electric vehicles, 5G technology, and countless other high-tech applications. This industrial demand is non-negotiable, and it's growing exponentially as the world moves towards a greener, more electrified future. So you have this perfect storm. On one hand, you have soaring investment demand from people looking to protect their wealth from inflation. On the other hand, you have inelastic and growing industrial demand that needs to secure a supply chain no matter the cost. These two powerful forces are converging on a market that, as we've discussed, has a very tight physical supply and a paper market that looks primed for a short squeeze. It's a powerful combination that we haven't seen in this exact configuration before. The industrial demand component adds a whole new dimension compared to past rallies, creating a solid floor under the price that didn't exist in the same way before. Let's put it all together. The paper market is quiet, but it's a deceptive quiet. The physical market is screaming that there isn't enough silver to go around. History shows us that these are the exact conditions that can lead to explosive price moves. When the paper price is finally forced to reflect the reality of the physical market, the move could be swift and dramatic. We're not just talking about a small percentage gain. We could be looking at a fundamental revaluation of silver's role in the global financial system. The low open interest means there are very few sellers left to stand in the way. The rush for delivery is a ticking clock on the available inventory. It feels like the calm before the storm. Of course, nothing is guaranteed in financial markets, and you should always do your own research. This is not financial advice, but the evidence is compelling. The silver market is exhibiting classic signs of a major bottom and the early stages of a powerful new bull market. The pieces are all in place. It's one of the most interesting and asymmetric opportunities in the markets today, and it's definitely something every investor should be paying close attention to. Thanks for watching, everyone. It's a fascinating time for silver, and I'll be sure to keep you updated as this story develops. If you found this analysis helpful, please hit that like button and be sure to subscribe so you don't miss our future updates. Let me know your thoughts on the silver market in the comments below. See you in the next video.